All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be looking at your M1 and M2 used by the Federal Reserve or the central bank. Okay, before we move forward to M1 and M2, let's talk about currency in general. Okay, so we know that currency is used for exchange of goods and services, unlike bartering. So, exchange of goods plus services. All right, and most of the currency that we know today is either in the form of paper currency, so we have paper currency or coins. Now we talked about the value of the currency as well as its storage, okay, when it comes to paper bills in the last video. So we're not going to go into much more detail. All right, so when it comes to currency, you have paper currency and coins, and this is what is used for personal consumption, as well as things like capital investments, which is part of your aggregate demand and GDP. Okay, and maybe even net exports, so import and export. So if you have two businesses, let's say two neighboring countries where two businesses trade, okay, yeah, they pay cash when they trade. Okay, so you can use cash for import and export as well, such as the trade between Canada and the US. So if you have a business in Canada and a business in US, if they cross border to exchange goods, they may use cash. So import and export, so on and so forth. Now, apart from the current, okay, when it comes to your monetary policies, and we've talked about monetary policies in some of the videos on this channel. Okay, this has to do with government intervention, has to do with the intervention by the central bank, the Federal Reserve Bank, or the Fed, one and the same thing. And when it comes to monetary policies, the monetary policies look at liquidity, okay, of money in general. Okay, and that's the reason why we have two categories when it comes to liquidity. Okay, so monetary policies, they look at liquidity, and liquidity has to do with how quickly you can cash out, how quickly, how quickly you can cash out. Okay, so cash out. Talking about how quickly you can cash out assets. Okay, so this has to do with assets. Okay, if it's paper currency, for example, it's easy to cash out. Your accounts receivable, easy to cash out. So both of them are considered liquid. Whereas if you have a fixed asset, a capital investment, okay, which may be tough to sell, which may take time to sell, as a result of which it is not very liquid. Okay, it's not easy to cash out. Okay, so the Federal Reserve Bank or the Fed, okay, they look at liquidity when it comes to money. And that's the reason why they have money categorized in two categories. You have M1 and M2. Now, the M1 category covers things like cash, okay, traveler's check, okay, as well as your savings account, starting more recently. Okay, so savings account where you save your money and earn interest. So that would be your savings account. Whereas on the other side, the M2 category covers M1 plus. So it covers all three plus, okay, it covers your time deposits. So time deposits. And one such example of a time deposit would be your CD, your certificate of deposit. So certificate of deposit. On top of your certificate of deposit, it also covers money market funds, which are sort of like your ETFs or mutual funds, and we're going to talk about those as well. All right, so when it comes to M1, we've already talked about cash. This has to do with paper bills and coins. Okay. Traveler's check. So talk about traveler's check. This is what a traveler's check looks like in Canada. This one is from Bank of Montreal. You have the dollar figure over here, the signature of the person who's cashing it out. Okay, and the buyer. All right. So this is your traveler's check. Not very common now. Okay, however, this is something that is part of M1. Okay, so if you do travel to another country, for example, as a tourist, okay, it's easy to use a traveler's check, or it was easy back in the past to use a traveler's check, okay, as a form of payment. Right now, apart from the traveler's check, you also have the certificate of deposit or CD. Now, this is part of your M2. Okay, now when it comes to your certificate of deposit, obviously this is not the same as your savings account. Okay, you have to have a fixed term, let's say 3 months, 3 years, so on and so forth. And at the end of the term, you get paid interest. Okay, and that would be a certain amount of interest, let's say 5%, 6%, and so forth. Okay, these are low risk investments. Okay, however, you cannot withdraw money at any given time, just like your savings account. All right. Now, apart from your CD, your certificate of deposit, you also have your money market funds. Okay. When it comes to money market funds, as you may notice, this is sort of like investment in an ETF. Okay. You have, okay, all these different banks that make up the fund. Okay. And these are low risk investments. Okay. If you look at the risk category, the risk rating, this is low risk, as stated by the fund facts. And apart from the low risk investment, you also have a lower return than some of the high risk ETFs. Okay, so the return may be low as well, okay, because of the amount of risk. All right, so 4.64%. Okay, the latest return on investment, 2024. All right, so this is basically your money market fund, and this is offered by a bank such as your RBC. Okay, and this is part of your M2. So when it comes to M1 and M2, this is what is used by the Fed to work on the monetary policies. Okay, so when they measure liquidity, when they figure out how liquid the assets are, they categorize them in M1 and M2. And based on this category, they decide whether it's time to bump up the interest rates, whether it's time to lower them down, so on and so forth. Okay, so that would be it for this video. On behalf of B Electronics, this is Ubay. Have yourself a great day.